You are sitting there staring at a microscopic $10,000 account thinking you are an absolute financial mastermind because you discovered 3 generic index funds on a retail brokerage platform, but you are completely blind to the reality that complexity is just a status signal for individuals who want to feel intelligent while staying thoroughly poor. If you cannot explain your entire asset allocation strategy to a 12-year-old child without using convoluted financial jargon, you are not actually investing your capital. You are just gambling with your long-term retirement security on a system that was systematically redesigned to exploit your passive compliance. Let us be entirely clear about the brutal mathematical facts, because the global markets do not care about your emotional attachments, your hypothetical spreadsheet models, or your lazy assumptions regarding how wealth is compiled over a 30-year horizon. You think that by tilting your small pool of cash toward a specific dividend yield or a tech-heavy growth metric, you are somehow outsmarting the institutional desks. But the truth is you are just choosing which specific flavor of market mediocrity you want to subsidize with your life savings. The broad financial media loves to sell you the beautiful narrative of individual choice, telling you that your asset weighting is the ultimate lever of financial freedom. But underneath the surface of these passive retail products lies a completely different mechanism that quietly drains your purchasing power. Consider the absolute absurdity of tracking a massive basket of 3,000 innovation companies through a generic exchange, traded product, or an unmanaged mutual fund, thinking that holding names like Apple, Microsoft, and Nvidia at a slightly altered percentage is going to fundamentally redefine your economic destiny over the next decade. People love to overcomplicate the basic process of wealth generation because it makes them feel important, but real sustainable freedom comes from the incredibly boring, entirely unglamorous discipline of recognizing exactly where institutional liquidity is flowing and keeping your capital completely detached from structural losers. We are currently witnessing one of the largest structural sector rotations in modern financial history, yet the average retail investor is sitting comfortably on a couch, debating whether to allocate an extra 10% of their paycheck into an international fund that has chronically underperformed for over a consecutive decade. The broad indexes continue to print all-time highs because a handful of massive tech monopolies are aggressively masking the underlying rot in consumer-facing retail and traditional industrial sectors, and your blind index fund forces you to hold every single sinking ship right alongside the few operational rocket ships. When you buy into these aggregated retail baskets, your winning investments are constantly being forced to pay the structural alimony for your losing investments, which means your total portfolio returns are being systematically averaged down to a level that guarantees you remain dependent on a traditional corporate job. Let us dissect the actual mechanics of these highly praised Fidelity vehicles. Starting with the high dividend options like FDV, which retail investors falsely perceive as traditional cash, generating cash cows filled with sleepy utility companies and old-school energy providers. The hilarious reality is that these funds are heavily concentrated in the exact same trillion-dollar tech conglomerates that dominate the broad market indexes, meaning your supposed income safety net is entirely dependent on the exact same regulatory and cyclical risks as a high-tech growth fund. Apple alone distributed over $15 billion in nominal dividends last year, which sounds like an astronomical figure until you realize that on a per-share basis the actual yield is a pathetic fraction of a percent that gets thoroughly incinerated by real-world infrastructure inflation. If your primary engine for generating lifelong passive income relies on large-cap technology firms maintaining historic profit margins, while real consumer wages are thoroughly negative, you are building an entire financial castle on a foundation of pure sand. The mainstream advisory complex wants you to look at a blended dividend yield of over 2% and a historical 5-year growth rate and believe that the compounding snowball effect will magically solve all your financial limitations by the time you reach retirement age. They show you beautiful linear projections where $10,000 miraculously balloons into hundreds of thousands of dollars over 30 uninterrupted years, completely omitting the reality of sequence of returns risk, monetary debasement, and the constant threat of technological obsolescence. Then you look at the growth-tilted alternative like FNCMX, which blindly tracks thousands of companies heavily weighted toward innovation, forcing your capital to ride the volatile waves of speculative tech valuations where the average dividend yield is practically non-existent. This fund selects businesses entirely based on their market capitalization rather than their actual underlying profitability, meaning you are automatically forced to buy more shares of a company as it becomes increasingly overvalued and speculative during a classic market bubble. The historical annual share price appreciation looks incredibly attractive on a colored chart, But those are entirely paper profits that do not put a single dollar of liquid cash into your pocket to cover your escalating cost of living unless you actively liquidate your core positions. When you enter a period where professional money managers are completely maxed out, with 97 out of 100 institutional allocators already fully invested in equities, there is literally no fresh capital left to push these bloated broad market valuations higher. The direction of internal money flows matters infinitely more than total aggregate inflows, meaning that a massive tech-heavy growth fund can easily experience a lost decade, while specific, unglamorous commodities and physical infrastructure sectors quietly experience a massive renaissance. The third piece of this retail puzzle is the total international fund, like FTIX, which exposes your capital to thousands of enterprises scattered across developed and emerging landscapes outside the borders of the United States. The marketing materials claim this provides essential global diversification, forcing you to allocate cash to economies like Japan, Germany, and Great Britain, while completely ignoring the structural demographic decline and regulatory paralysis that have crippled these regions for 20 years. They point to the rapid dividend growth rate inside international markets as a hidden treasure, but that growth is entirely denominated in foreign currencies that face massive structural devaluation risks against a weaponized global reserve currency system. You are told that holding companies like Taiwan Semiconductor or ASML protects you from domestic economic downturns, but the reality is that these global supply chain linchpins are deeply tethered to the exact same macroeconomic constraints as their American counterparties. The entire exercise of shifting your portfolio weights between 70% growth and 50% international is a profound psychological trap designed to give you the illusion of active control while keeping your money completely locked inside a stagnant passive ecosystem. If you choose the dividend-tilted route, the model suggests you will eventually receive over $2,000 every single month in pure passive distributions, allowing you to live comfortably without ever reducing your total share accumulation. But that entire projection relies on 3 decades of perfect economic stability, completely ignoring the fact that a single major systemic crisis can force corporate boards to eliminate their dividend payouts in an instant to preserve baseline operational liquidity. If you opt for the growth-tilted configuration instead, your account balance might show a significantly larger nominal figure on your digital screen by the time 30 years have elapsed. But your actual realized cash flow will be shockingly low. You will be left holding a massive pile of paper wealth with a monthly dividend distribution that fails to cover a basic grocery bill, forcing you to rely entirely on the fundamentally flawed 4% safe withdrawal rule of thumb. The 4% guideline is a theoretical relic of a completely different macroeconomic era, assuming that a retiree can systematically liquidate portions of their equity portfolio every year without ever facing the catastrophic reality of a prolonged bear market at the start of their retirement. If the broad market experiences a severe structural contraction the exact year you decide to stop working, you will be forced to sell your depreciated growth shares at an absolute mathematical loss just to cover your baseline living expenses. This process rapidly accelerates the permanent destruction of your capital base, ensuring that your supposedly massive growth portfolio runs completely dry long before you reach the end of your natural life expectancy. The system is deliberately engineered to sell you these contradictory choices, keeping you thoroughly distracted by the debate between paper growth and dividend yield, while the large institutional funds collect their recurring management fees completely risk-free. Wall Street never adopts a passive buy and hold philosophy for their own institutional capital, because they understand that wealth is maintained by aggressively moving liquidity into sectors with structural pricing power. They promote the doctrine of passive diversification to everyday retail market participants, because it keeps billions of dollars of retail capital completely stationary, creating a highly predictable pool of liquidity that they can easily trade around. The velocity of modern technological disruption means that massive corporations that appear completely invincible today can be rendered utterly obsolete or structurally displaced within a matter of months by advanced artificial intelligence systems. Relying on a static rules-based index fund to manage your generational wealth across several decades is a form of financial negligence because the index is contractually obligated to hold on to declining enterprises until they have already lost the vast majority of their market value. You cannot compound real purchasing power by holding a generic bucket of 500 or 3,000 stocks when the underlying currency unit is being systematically diluted through continuous global monetary expansion. The real divide in modern society is not between the individuals who prefer dividends and those who prefer growth. It is between the passive crowd that accepts historical averages and the disciplined elite who position themselves exclusively in front of structural capital flows. If you want to achieve true financial sovereignty, You have to completely break free from the conventional retail investing dogmas that are explicitly designed to average down your returns and prolong your dependence on a traditional wage-earning lifestyle. Stop treating your investment portfolio as a passive hobby where you blindly allocate capital based on generic online articles, and start analyzing the hard, unvarnished data of global sector rotation and physical resource scarcity. The foundational layers of the global economy, the energy grids, the raw physical commodities, the advanced defense systems, and the localized industrial infrastructure are where real wealth is actively generated and protected during periods of intense macroeconomic transition. The choice before you is entirely simple. You can either continue to participate in the passive retail illusion, adjusting your percentage dials on a small basket of unmanaged index funds while hoping for a generic market miracle, or you can accept the reality of how capital actually operates. True freedom requires you to reject the sophisticated, over-engineered financial products sold by major asset managers and embrace the simple, unglamorous discipline of structural capital allocation. The numbers will continue to play out with absolute mathematical certainty, regardless of your personal theories. And the individuals who refuse to remove the dead weight from their portfolios will inevitably fund the massive gains of the disciplined minority who understand the actual rules of the game. It takes absolutely no extraordinary intelligence or complex algorithmic modeling to secure your financial future. It merely requires the ultimate clarity to see the markets exactly as they are rather than how the retail marketing machines present them to the public. Stop overcomplicating your strategy. Stop chasing the collective validation of the retail investing community, and start respecting the basic laws of structural liquidity movement. Real world asset scarcity and systemic monetary inflation. The broad market average is a financial anchor that will guarantee your long-term returns remain thoroughly mediocre, while the real-world purchasing power of your nominal capital is steadily eroded by escalating real-world costs. If you are truly serious about building generational wealth that survives the intense structural upheavals of this decade, you must actively detach your money from the passive systems that profit from your continuous complacency. Take a completely detached, clinical look at your current allocation. Eliminate the structural losers that are quietly dragging down your potential compound growth, and focus your capital exclusively where it is treated with the absolute highest level of respect by institutional markets. The roadmap to absolute economic independence has never been more obvious for the rare individuals who are willing to discard the conventional illusions and execute a strategy based entirely on raw macroeconomic reality. Do not allow the comfortable lies of passive retail diversification to blind you to the fact that half of your unmanaged portfolio is silently decaying underneath the cover of a few massive technology stocks, hitting nominal all-time highs. The history of financial markets is a continuous cycle of massive wealth transfers from the passive, undisciplined majority into the hands of the highly focused, intensely realistic individuals who refuse to compromise on their capital efficiency. Position your capital with absolute intentionality. Ignore the daily noise of the mainstream financial media commentary, and let the rest of the market participants provide the counterparty liquidity while you quietly build a fortress of real, tangible wealth.